Hello, ladies and gentlemen. Greg McCloskey from ForexLive.com. This is a Kickstart video where we take a look at three of the major currency pairs of euro versus US dollar, dollar versus yen, and sterling versus US dollar from a technical perspective. Today's date is July 15, 2024. Let's get started. Of course, we had the assassination attempt over the weekend, and that led to a steeper yield curve, as that is the trade for that we've seen traders react to if former President Trump is in fact elected president. So the odds went up over the weekend after the assassination attempt that he would be the next president of the United States. Time will tell, of course, but what that means is that we probably have higher tariffs. That could be inflationary. We also would have deportation of a number of workers, particularly in the service sector, that could cause a higher inflation as well. Of course, he would root for lower rates from the Federal Reserve, maybe even replacing Chair Powell because he's not dovish enough. And all that is leading to that steeper yield curve. The 2 years near unchanged. The 10-year yield is currently up around 4.5 basis points, and the 30-year is up about 6.2 basis points. The 2-10-year spread is near around minus 22 basis points. It's still working its way toward a flat yield curve between the 2s and 10s, but the expectations are perhaps it gets there at some point going forward, so be aware, be prepared. And as far as the foreign exchange market, we'll start by taking a look at the euro versus US dollar from a technical perspective. And we saw an initial move to the downside after the weekend's events, and that sent the price down to retest this broken trend line. This broken trend line was happened midweek, and then also at the end of the week, we failed on the first attempt, came down to this swing area before Friday's move back to the upside. We did so the retracement back to the old trend line is and the bounce is good news for the buyers, and we took the price back up to this swing area where we initially did find sellers on Friday near the low of that swing area. The swing area goes back to this period right through here. We had a number of different swing lows and swing highs. It failed on the last break right here before moving to the downside. We then returned to that area here, initially found sellers against that level, moved above it, and tried to use this level as support to push higher. And we had a move to the upside here, but that failed, and we started to rotate back to the downside. Admittedly, it got wonky through this area right through here, but there are other instances where the price did find resistance against that level. And a number, well, 1, 2, 3, 4, 5, or 6 weeks ago, the price came up into that area, found willing sellers again. So we maintained this level as a resistance level, and in trading here today, we did move to the highest level going back to this day right here, which is in March, but the market did find willing sellers against the high of that swing area near the 1.0918 level. We had outlined this level as a swing level that we needed to get to and through, and we went up to the top of it and fell off a little bit. We're currently trading at 1.0904. Nevertheless, the buyers remain more in control and have been more in control since moving above these cluster of moving averages right here and basing against this swing level and moving higher and trading last week, getting above the trend line, so on, and other levels like the 50% retracement level at 1.08695. So all that is positive for the at least the short and medium term for this currency pair. On a break of the 1.0918 level, we look toward the 33 level, which represents a 61.8% retracement. That's of this move down from this high going back to December 28th, so the end of December high. That level comes in at 1.0933. Let's take a look at the dollar versus yen next, and we take a look at this on the 4-hour chart. We did have on Wednesday, I guess, the sharp move to the downside on the back of the CPI data that pushed the price sharply to the downside here, and that I guess that was on Thursday, and the price fell all the way down toward the 61.8% retracement of this move to the upside, the last move to the upside. There was a speculation that there was a central bank intervention by the Bank of Japan as well, taking advantage of the weaker CPI data at the and the lower US dollar to push the price even lower. But we did find that support against a 61.8% retracement on Thursday, and again on Friday. You can see the double bottom coming right near or against that 61.8% retracement level, and the market rotated modestly into the close. In trading here today, the price high at least after the initial break higher after the weekend events, saw the 50% retracement of the same move to the upside, hold resistance, and that's going to be a close barometer for traders as long as the price can remain below the 50% retracement. The bias, still in the short-term release remains to the downside, and some more conservative traders might also look at the 200 bar moving average on the 4-hour chart now that it tried to get a move above that again on Friday and failed and rotated back to the downside. So these two levels are going to be levels of importance for sellers who feel like the price is to the downside now that we had these highs come in place over the last 2 weeks. These were 1987 highs. Obviously, the market was bit was overbought on the move to the upside, the trend move to the upside. So this may still be a technical correction, but as long as watch the 50% of this last move to the upside for clues. At some point, we're going to do this. We're going to put this all the way down to levels like here and look toward the 155.78 as a target, perhaps. Maybe even go even further down to our low price right through here, and look further down to 153.64. That's the extent of this big, huge trend move that's seen the price from the end of December move up from about 140 to 160.61. It's not unusual to head on down and correct and test the 38.2% retracement. So be aware there's room to roam, but before we start to roam further, we still have to break certain levels in the short term, like stay below the 50%, get below the 61.8% retracement, and then we start to move those Fibonacci's further to the downside. So be aware of that. There's lots of room after the sharp move to the upside since the end of December in this currency pair. Finally, let's take a look at the sterling versus US dollar, and it continues its move to the upside, but did find some resistance sellers on Friday and again today near, although it did break above that topside trend line here. That break of the trend line should have sent the price higher on Friday. It didn't. It rotated down. We came back up in trading here today and rotated back down a little bit as well. That trend line comes in well short of this 90.5 high that we saw in trading here today, but it's going to be the key barometer for additional moves to the upside. It's also near the highs that we've seen, is also near the key and natural resistance at the 130 level. So need to get above the 130 level to open the door for further upside for the sterling versus US dollar. Where do we look on the daily chart? Well, this 29.95 level was a swing high going back to this point right here, which is in July of 2023, July 28th to be exact. Get above that level and get above the 130 level opens the door for potential look toward the high price that we saw in 2023. That level came in at 131.41. So there you have it. I'll look at 3 of the major currency pairs. Kickstart your trading day for this day. My name is Greg Michaelowski. Good fortune with your trading. Bye-bye now.